Hello everyone, and welcome back to another video. This is Joey, founder and creator of myatmm.com or at myatthemoneymachine.com. First off, this is a disclaimer to get that out of the way. This is not investment advice. I am not a financial advisor. This is for education and entertainment purposes only. So now we can move on. All right, so this is the follow-up to the weekly review. The options that we had placed on Sunday night, early Monday, have executed. I've gone through and made the modifications for the ones that did not execute to get them to go through. So now we're going into the application. We went and downloaded the account history and the transactions that occurred in Robinhood with the plug-in, the Robinhood transaction history downloader. And we have gotten those transactions right here listed. So now we're just going to go back into the web application, the myatmm.com website, and enter those transactions. So we need to come over to the cost basis. And the first one is Clove. So let's go ahead and go to Clove. All right. And what happened with Clove? So we have a put and a call. And so two new positions. Let's go ahead and open those up. And the first one was $1 put on 12/16. So we're selling to open. I believe I said a put. I remember I said 12/16, and I think I said $1. So let's just double check that. And also these all executed on 12/5. And actually, when I get to these, I'll just double check these because these look like older ones that I need to delete that are probably already recorded. So we'll find it out when we get to them. Okay, but these were on December 5th, and I am recording this a day later, so I will need to update the date to December 5th. Okay, so sell to open, $1 put, December 16th. One contract. Nope, it was two contracts. All right. And it was for $1. All right. All right, so save. And again, that put it down here in the proposed records. So we want to add that down here and click save to retain it. Okay, the next position that we opened, we're done with this one, so we can go ahead and delete this. The next one is a $2 call December 16th. Sell to open, call. Can't remember how many contracts. We'll look again. And if I remember, was it $2? So $2 call. We did 4 of them. $2 call, 4 of them at $1 a piece. So 4 contracts, $1 a piece. And yep, need to make sure I change that back to December 5th. Save. And let's move that down and retain it by clicking save. Okay, so that's saved successfully. All right, so the next one, go ahead and delete this. All right, moving on to MVIS. And also we can go ahead and just look at this overview of what we got now. Okay, MVIS. $3 put. So sell to open, a put. I think we did 1 contract. Nope, we did 2 contracts. And I think, was it December 9th? Yeah, December 9th expiration. We did 2 and they were $7 each. What was the strike price? $3. Okay. So $3 put December 9th, 2 contracts. December 9th, 2 contracts, put $3, 7 each. Is that right? Yep, and 14 total. So click save, move that down, click save. Okay, so MVIS, we got this one recorded so we can delete it. Alright, so now we got a $4 call. December 5th, sell to open. How many contracts? We did 2 contracts. What's the expiration? 12/9. So that's this Friday. The strike price was $4. How much did we get for that? Just $1. Yeah, so there's a lot of low premium ones. And I have a plan to stop focusing on these. I think I'm pretty much done with the lower priced ones. As soon as I get out of them, I'm going to stop messing with them and focus on the higher premium dollar amounts. I think I've learned this process enough. Okay, so we need to move this down and save it. Plus, as I said in the last video, I'm in the process of moving a lot of the capital over to Ameritrade and using Thinkorswim, and they charge a 65-cent option fee to trade option contracts. So I definitely will be not be focusing on the smaller premium amounts, because that pretty much, I mean, 65 cents from $1, obviously it takes you know, most of the money you would be collecting, so it doesn't make sense to trade those. All right, so MVIS is done. So now on to NVAX. Okay. Alrighty. 300 shares. We have these 3 contracts already, but this one I believe was a put. Yes. So we want to open a new position. Set the date for yesterday. Sell to open. It was a put. Right? Yep, a put. Number of contracts we did was 1. The expiration, I believe, was December 9th. Yes. Alright. Scroll down. Okay, the strike price was 16. And the premium that we received for it was $70. Okay, so save. Pull that down into the transaction editor, or the ad. Click save to retain that. Okay, so that is saved. The premium saved on that one. So our cost basis with premium is now down to $22.62. Oh, and something else. I did add a put, and the funny thing about it is I think I added some other puts, didn't I? And I did not account for the collateral, so I messed that up again. I mean, I didn't mess it up, I just forgot. So, okay, so this one is 400 because we added 100 from the one put contract, and the collateral for that is it's $16 strike price, so that's $1,600 in collateral we have. So we need to click save on that. Okay. All right. So that's been accounted for. And let me just back these up so I can find out what those other puts were. The MVIS and Clove. So we need to go back to Clove real quick. All right. So the put, we did 2 puts. So that will bring us up to 600 shares. And 2 puts at $1 strike price, so they're 100 each, so that brings the collateral to 200. So retain that. Okay, so now we definitely are done with Clove, and we need to go account for this MVIS put. MVIS, the put, we did 2 contracts again, did we? Yeah, we did 2 puts again, so that'll bring us up to 400 shares. The collateral on those 2 puts is 300 each, so $600 is the collateral. Click save to retain that. Okay, so NVIS is done, and NVAX we already accounted for all that, so we can go ahead and delete these things. And 2 of these RUMs I think we've already accounted for, and we're going to go find it out real quick. So just go to RUM, and I guess the easiest way to find out, well, let's just see if we have any 1128s. We do. We have an 1128 there. That's a 27. It might be the same thing. I don't know. All right, so what are these? The 1128 is a $12 call. $12 call. Was it two of them? It was. And was it 7 cents? It was. So we already have this one recorded. So this one right here can go away. And let's go see if this one's already recorded. It's a $9 put. Okay, we do not have a $9 put listed here. Was that the one? Okay, look. Yeah, the expiration 12/2. I should have looked at that first. So yeah, that one's already been recorded. It's already expired. Okay. Okay, so first things first, we have to enter this call on 2 contracts. So we have a new position. We sold to open yesterday. Sold to open, a call, 2 contracts. 2 contracts expires December 23rd, so we had to go out a little ways. So 3 Fridays from now. And that's probably because we're at a higher strike price. Yeah, $11.50. All right, and the price that we got for that was a nickel. $10. So move that down, click save to retain it. All right, delete that. All right, so next up is a put. So we have another new position coming on board. And December 5th, sell to open, and it's a put. How many contracts did we do? We did 1 contract. Expiration December 9th. Strike price $8.50. Okay, and the price we got for it was $40. Okay, click save and pull that down and click save to retain it. Alright, so we're done with entering all the transactions. Oh, and again, we need to account for that put collateral. So we only have 1 put right here, and it's 1 contract, so we need to raise this up by 100 shares. 500 shares in the collateral we had to put out for that was $8.50, so that's $850. So click save. And you can see if that executes, it'll bring our cost basis down to 1070, and with premium, we're already at a cost basis of 834. So we're still doing pretty good on this one. I will say that we're going to go back to the dashboard, and overall we are negative quite a bit, and that's because of NVAX and RUM. As you can see, NVAX and RUM, the last prices is $16.73 and $7.92, and as you can tell, our cost basis for NVAX is $25.20 without premium. With the premium, we're down to $20.96, but it's trading at $16.73, so that's where the negative is coming from there. And also in RUM, you can tell it's trading at $7.92, but we're at $8.34 with the premium and $10.70 without the premium. So that's again why it's these two right here are the ones pulling it down into this negative 1600. But that's because the stocks are down. When the stocks start to go up, or over time we collect more and more premium, this cost basis with the premium will continue to go down, and the overall will start to come back down too. Or I should say go back up, because it'll be coming from negative back up into positive territory. All right. Okay, so the last thing we like to do is check the premium, see what we got so far for this month. And so right now, 1 week in, we have $142 in premium that we've brought in. I will say that this month is starting out slower because we are in the process of moving capital over to another portfolio, and also the ones that we do have are pulling in some smaller premiums themselves. So I got some ideas about how to wait or see if we can get more premium for them. Some of the strategy involves, like some of the ones I had to set sell premium on weekly options like 2 or 3 weeks out. Another idea to do is instead of doing that, to not sell the calls on those higher priced ones, And I don't want to drop the price down to a dollar amount that is making money, because I don't want to get below the cost basis that I'm involved in them, because then there's always the possibility that the price goes up and then you end up getting called out and then you lose the capital. But the idea that I had instead was knowing that stocks bounce up and down, and they're always going up and they're going down and then they're going up and then they're going down, either in a downtrend, side trend, or uptrend. But knowing that, it might make sense, if you can't sell calls for any amount of premium, to just sell the puts on the lower end, because you'll get basically an at the money premium on those. But if the stock starts going up towards your cost basis without premium, then that will cause the premium amounts to go up on those calls. So then you could sell calls at that point in time for the weekly again, so it has a very short duration, and then you'd make a lot more money than going out 3 weeks and only selling a call that's like $6-7 above where it's trading at now for a penny. Whereas if I just forgot about trying to make that penny, waited till the stock started going up, if it did start going up, if it doesn't go up, then we're just trading the puts on the lower end on the other side of it, and we're making as much premium as we can on those. And if it does go down, then it'll pull the cost basis down, so it'll allow us to do that more. So in any case, I'm going to be focusing on doing that with like NVAX and RUM to illustrate what I'm talking about. But obviously that'll just take time over the next several weeks to illustrate that. But in any case, so that was the weekly review follow-up, and we entered the transactions. Everybody have a good day. I'll talk to you next one. Bye.